Yeah, so we will start the discussion for the day. There are few methods that costing follows. So what is costing? When we say DM, DL, manufacturing overhead and fixed overhead, this become a cost of goods sold or manufacturing cost, only related to manufacturing. So when it comes to calculations in your real exams, you will have very easy calculations. Just you need to know the concept. Rest is plus minus. So, for example, like we will start with the production cost. Now, production cost under absorption. Now, what is absorption? Absorption, another name is full costing, or its name is where we add the fixed cost plus variable cost together. Absorb is a word that shows that you are going to absorb every cost. Absorb means that you are going to include all kind of cost in your calculations. So you can see the formula is DMDL plus variable and plus fixed because of the absorption costing. While variable costing is simple, it just assume that the cost of the product is the one that is only variable. So how it depicts like direct material is variable because it keep changing. Direct labor keep changing if we have more labor, less labor, and variable manufacturing overheads. These three will be changing. So then the formula, if a question comes, calculate variable cost by calculate product cost by using variable costing, you will see that these three only, TMDL and variable overheads, will be the part of the calculation. So this is the concept related to production cost. Now there is a cost called period cost. Now in absorption, it's variable plus fixed. But in period cost, this is 1, 2, and this missing that we didn't took in the product cost. So here we will add it as a period cost. So you can expect very simple question, calculate product cost by variable costing, by absorption costing. That time you can just quickly write these lines and pick and choose the figures and make the total. This is very interesting that we are going to discuss impact on operating income. Now, what is operating income? Operating income means that your profit and loss after your sale and your cost, you have income. Now, if I use big value of cost that comes from absorption, so my profit will be less. And if I assume variable cost because it will be less, so my profit will increase. So sometimes for internal purposes, for budgeting, we use these concept. So for example, we are a group of companies. We have a head office and there is a very small company inside. And I am the financial controller of that small company. So my effort will be in order to increase my profit, I want to avoid the rent. So I will tell the other financial controllers, CFOs that look, we are a very small company and maybe 1 or 2 employee, you have 100 employees, you're getting more rental. We will not put rent figure in our accounts. Management accounts means internal reporting because we can work from home also. Why we should pay the rent or fixed cost? So these are the practical scenarios that generally works in the company, and we discuss, we agree, and for management accounting, we have a flexibility to adopt any method like production, like absorption or variable. You must be knowing that all accounting goes by default on absorption. Means that when we record a debit and credit, we don't differentiate between fixed cost and variable cost. Whatever expense, we debit it. So absorption is an accounting way of doing things, and the variable costing is a management accounting based reports. So that's the concept. Now see, he says that when everything produced during a period is sold, right? So means you produce 100 units and you sold 100 units. So means that you have no or very less closing stock. Maybe 10 was the opening stock, 100 you produced, and 100 units you sold in this month or a year. So you can see the closing stock figure is very less. Now recall the method of calculating cost of goods sold. What is cost of goods sold? Opening stock, add purchases, and less closing stock. Now, very interestingly, I'm just using a concept of mathematics. So if the closing stock figure is higher, means the cost of goods sold is lower. This is how it works. Because this plus this minus this is your cost of goods sold. So if you have a higher closing stock, means that your cost of goods sold will be lower. If your cost of goods sold is lower, then your gross profit is higher. This is logical because if you just see cost versus profit, if your cost is less, then your profit is more. If your cost is more, then your profit is less. That's the way it works. So this is what he assumed. He says when the production exceeds sales, means you have more production, less sales. So your ending inventory will exceed. So this is a scenario. First scenario I told you that is less production, more closing stock less, which is this one. Production is less than the sales. So means closing stock will always be low. Here, production means you are producing more, you are selling less. So ending inventory will be more. So when in the ending inventory will be more, then your cost of goods sold will be less. And when the cost of goods sold will be less, then the operating profit is higher under the absorption costing. So this is what you need to memorize. There are 4 or 5 questions related to it that you should know. In the past papers, when you solve them, it will test your knowledge that you know that if closing stock figure is higher, the profit figure will be lower. And if closing stock is higher, then the gross profit figure will be lower. It will be higher. I mean, if this is higher, this is lower. If this is lower and this is higher. So that's the concept will work. And this is opposite that when the production, so you have less closing inventory means this arrow sign is now down. So means cost of goods sold has increased. So under absorption, your profit will be lower, while in variable costing, it will be higher than the absorption one. So this is a good summary slide that can explain your concept that if production exceed or decrease. So the main point is here, the closing stock. Closing stock is more, so cost of goods sold is less. If the cost is less, then GP is more, and vice versa. Means